Look at a price chart where the highs and lows squeeze together into a tight, narrow band. The common interpretation is that you are looking at a coiled spring, ready to explode with momentum. The moment the price crosses that upper resistance threshold, the tension releases. The signal flashes by, and traders execute their orders. But look at how identical setups can diverge. On the left, the price catches a bid and climbs into a trend. On the right, it immediately reverses, plummeting back below the breakout line. Historical data on market structure shows that 40% of these breakout trades end up as traps that punish early entries. Traders fall for this because they equate a compressed price range with guaranteed directional momentum. Narrow price action signals a state of efficient balance, or a specific structural setup used to hunt for retail liquidity. When a chart goes sideways, the market is not inactive. Buyers and sellers have found a temporary equilibrium, agreeing on a narrow window of fair value. The longer this equilibrium lasts, the higher the risk of the volatility paradox, where prolonged tight ranges build up systemic fragility rather than safety. Retail traders cluster stop-loss orders outside narrow boundaries, creating dense liquidity pools. Algorithms push the price past the ceiling to trigger these stops. This floods the market with buy orders, letting institutions take the opposite position. As price reverses, volume shows virtually no participation. A false breakout is a successful institutional maneuver designed to extract liquidity from impatient retail traders. Genuine market expansion requires a structural shift in underlying supply and demand. Before a real breakout, you will typically observe supply exhaustion, a phenomenon where sellers completely disappear from the market. You can see this exhaustion in the volume. As price pullbacks get tighter, the volume histogram shrinks. The available supply of sellers has been absorbed. A valid expansion requires a significant surge in volume, confirming that new, aggressive participants have entered to drive the move. This chart illustrates the probability of future price discovery from a single point of balance. Look at the point labeled P of T, where the price diverges into multiple potential future paths. True expansion is proven by volume and structural acceptance, not simply by crossing a line on a chart. Action bias, a cognitive flaw that prioritizes movement over calculation, is the primary driver behind traders falling for these traps. Watching a static screen is psychologically uncomfortable. When the market is sideways, uncertainty translates into a physical need to execute a trade just to feel productive. Screen fatigue compounds the problem. To relieve internal tension, traders often force subpar setups, abandoning their strategy to satisfy the urge to act. Market infrastructure mathematically punishes this psychological urge. Trading during periods of equilibrium usually results in being the liquidity consumed by the rest of the market. Success depends on moving away from attempts to predict exactly when a period of price compression will end. The actual objective is reactive, waiting patiently for the market to prove that an expansion has already begun. The rule is to let the market break first. Demand to see volume participation before risking capital. In a system that rewards the fastest execution, the ability to wait for structural proof provides a tangible advantage over the rest of the market.